It's a real pleasure for me to be here. I'm not sure what kind of a country I'm going to have when I get home, but it's great to be here in South Africa today and be with you. It's also a pleasure to represent Jennison Associates and our global growth oriented fund. A little bit of a background here. Oops, too far right off the bat. Quote from my partner, Mark Barabo: if you have engineered your process to always look for major disruption, you aren't going to miss it. This is a strategy that he and I founded in October of 2004. So we've just passed our 20-year mark with this strategy, continuous management. And if you think about everything that's happened over the last 20 years, we've seen the evolution of the original internet morph into the mobile internet, broadband wireless. We've seen the introduction of smartphones. We've seen the introduction of e-commerce. We have seen the rise of social networks and social media. We have seen the transition towards the cloud and cloud computing. And now we're watching the evolution of AI. We've captured in the portfolio representation in all of those areas, and it has led to a very strong track record of performance. We moved the team to Jennison in 2011. And in the intervening years since our start of the track record in 2011, we have produced just shy of 15% annualized with this strategy, an excess return over the ACWI benchmark of about 600 basis points, just shy of 600 basis points. So it's a strategy that we have created with a process that is specifically focused on identifying the best growth opportunities that I often call the opportunities of today and tomorrow, not yesterday's, not last year's, not last decade's companies. Here we go. Okay, so couple comments on why we invest in, why we believe in growth. First of all, this is an interesting slide. It's an interesting contrast to the value slide. I think it's just a different way of looking at the data, different time periods. But what we've done here is taken the ACWI benchmark and we've quintiled the benchmark over rolling 5-year periods by earnings growth. If you then look at the performance by quintile, you see that the strongest quintiles of growth produce over rolling 5-year periods the strongest return streams. So it's our objective and the work of our analysts to try to find and identify those companies that have the best opportunity, the best shot at ending up in those top quintiles going forward over the next 3 to 5 years. Why do we do this in an active sense? Because actually, there's just not that many of these opportunities out there. If you look at the ACWI again and you look for strong sales growth and strong earnings growth, and you just take, for instance, a 7% or greater top line in sales and a 10% or greater earnings per share number over a 3 to 5 year period, you only have about 27% of the ACWI. So it's not that big of a universe. So it's really incumbent that you have a very talented team of analysts, very experienced, very tenured team of analysts focusing on growth every day, trying to find those needles in the haystack. And that's what we have at Jennison, where many of our analysts have been with us for 15, 20, and 25 years covering their sectors. What is it we're trying to exploit at the end of the day in this process? A view that in the growth space, and especially in the disruptive growth space, the higher earning growth space, there is a disconnect between what the market typically assumes and what the opportunity these real disruptors can create. Typically, and I was an analyst when I started my career, the market will try to forecast the next 2 years and then begin to assume some kind of reversion to the mean, a normalized growth rate. What we're looking for in our positions, our holdings, is a divergence. We believe that the positions, the companies that we invest in, will either have a more durable or longer duration growth profile to the growth, or the magnitude of the growth may be larger than expected, or some combination of the two. In terms of our process, we're looking at the end of the day for catalysts for inflecting growth. It could be a new product, it could be a new service that is attracting a tremendous amount of attention in the marketplace. It could be a new, offering new services, new capabilities. It could be disruptive to many incumbents. But we need to see that catalyst, that inflection in an accelerating growth as an indication that there's something here that is new, different, better, and exciting. We look for sustainable competitive advantages. That can be anything from proprietary technologies, patents, a network effects, a economy of scale that is very hard to replicate, a speed to market, our first mover advantage. And of course, we'd actually, even as growth managers, we do think about valuation. We want to make sure that we're not overpaying for these opportunities at the front end. So the portfolio itself, flexible, high conviction, global, 35 to 45 holdings, intentionally concentrated with no constraints around sector, industry, region, intentionally, because the minute you impose any kind of constraints, I guarantee you, as I've done this and seen it happen, that eventually you bump into the constraint. And when that happens, you're implicitly saying, I have to go and invest in the second or third or fourth best idea rather than the one I really want to invest in. So no constraints around sectors or country. The only guideline that we impose upon ourselves is that no single position goes past 10 years. And with the benefit of 20 years of history in this strategy now, it's only happened with 4 stocks. Apple in 2011, Tencent in 2017 out of China, Tesla in 2021, and NVIDIA last year. So you see the stocks that really have these massive game-changing opportunities don't come around every day, and you need to make sure that you're in those stocks in a growth portfolio environment to ensure that you can drive alpha over time. The portfolio itself, typically position sizes are based around our perception of risk and reward. We look as low as $5 billion in cap, although realistically speaking, we're going to be investing probably $10 billion and higher. And at the moment, given the market environment we're in, we've been dragged up more towards the mega caps. But there's nothing special to say that remains that way forever. We want to maintain the flexibility. Our new name turnover is actually closer to the 40%. I argue it's 35 to 45. And that's intentional because we do need to make changes from time to time. And I'm going to come back to that in a minute. And then from a portfolio risk standpoint, it's important, especially in this sort of a concentrated environment and portfolio, to keep an eye on risk in general. The biggest aspect of our risk management comes at the portfolio level, the work that the fundamental analyst undertakes to understand the business model, the risks to the model, and the valuation. But then we also do a lot of work around correlation. And I get a report every week that looks at the correlation, pairwise correlations across the portfolio by sector and across the portfolio as a whole. And this helps ensure that as we construct the portfolio and evolve the portfolio, we're not unintentionally adding exposure that is duplicative, that is increasingly highly correlated. And if something like that starts to happen and we start to see the numbers in a sector or the portfolio rise, we need to dig into those numbers and understand where those pairs are, creating the correlation issues. And then we can take some steps. If we want to add more to a particular sector that's highly correlated, we've got to take the capital from that sector in order to not further exacerbate it. We also then focus on a bunch of other variables as well. We think about the underlying drivers of alpha. We want to make sure that over time, the bulk of our alpha is coming from idiosyncratic stock-specific risk, not factor exposures, not currency, not country. And it does over time. We look at style analysis to ensure that even as we change the names embedded in the portfolio, that we still have the look and the feel of the growth portfolio, and we do. We look at upside downside capture just to make sure that we don't have any real outliers that are starting to change the dynamic. So there's lots of things that we look at over time to ensure that the portfolio hangs together and looks like it should and delivers the kind of profile that our investors expect. It's not a buy and hold approach by any means, although it's also not a high turnover approach. We have to be responsive and recognize, though, that things change over time. When the Chinese government took a much more, let's see, what's the word I want to use? So let's just say a much more antagonistic view towards private enterprise starting in 2020, we needed to exit our overall direct Chinese holdings, and we did over the following 9 months, right after they pulled the Ant Financial Group IPO in September of 2020. When interest rate environment changes from near zero to 4+, we do have to take some action in the portfolio, and we did. And of course, if the fundamentals change, business models change, products become a little more mature, or someone else arrives on the scene with a competing product, we need to be taking action, and we do. So this is by no means a stick your head in the sand and ignore everything for the next 10 years. The holdings have to earn their place in the portfolio every day, every week, every month, every quarter, every year. And a lot of our holdings do go on to be multi-year holdings. We also know that the bulk of our alpha comes from holdings that have been in the portfolio not just 2 or 3 years, but actually 4+ years. So it is a medium to long-term portfolio with the recognition that it's not a static market and we take action when we need to. In terms of the opportunities we see today, you're always going to likely see larger exposures in technology and a broad swath of consumer, because those are where the innovation really takes place. It's where the regulations are relatively low, where the capital intensity is relatively low. So if you think about today, generative AI, transformational technology, chips that are creating the opportunity, the foundation for AI, you're going to see exposure there. In the consumer space, direct-to-consumer, brand-oriented businesses are really attracted to us because they're harder to replicate. They have their finger on the pulse of consumer demand. They have better control over inventory and pricing. Areas of interest. Industrial is actually a come and go kind of category for us, but there are some really interesting opportunities today involved with the reshoring and onshoring of supply chains into Europe and into the US with energy transition and the like. So we have a little bit of exposure there. Healthcare, the biggest driver today is all around GLP-1s and obesity drugs that are increasingly prevalent in the marketplace. And then emerging markets. Our emerging markets can ebb and flow depending on opportunity, but there's some really fascinating businesses in e-commerce, in fintech that are taking place in the emerging markets, especially in Latin America, that we have exposure to and have had for quite a number of years. Just quickly wrapping up the portfolio, obviously managed by myself and Mark going back to 20 years. Rebecca Irwin joined us about a year and a half ago as a manager on this strategy, but she's actually been at Jennison longer than we have. She was an analyst for a number of years in the consumer space, contributed a huge amount of success to our performance in consumer names and in luxury brands in particular. And so we invited her to join us 18 months ago, and I have to say it's been a home run. Very, very pleased and excited to have her on the team with us day to day. And then the firm itself, 1969 founding, it's been around for quite a long time, has its roots in growth investing, although over the years it's broadened out into a number of different asset classes and styles. $214 billion in total AUM. Our global strategy that is part of this great new platform is approximately $18 billion in AUM. And we're usually quite proud about our client base. Client relationships are important to us. It's been said before in some of the comments. It's about people. It's about relationships. And not only is it people within the firm, but it's our relationships with our clients. And you can see here, 11% of these clients go back almost to the founding of the firm, 30 to 50 years. We have a large contingent of 20 to 30-year clients, large contingent of 10 to 20. So it is important to us to build relationships, to have the right people, and to have those conversations with people across the table about our strategy, about the ideas in them. And that has made for a fantastic 20-year product that I'm as excited to be a part of today as I was when we started it in 2004. So with that, on to the next person. Thank you.